Welcome to Investor's Guide. You're watching ET Now. Thank you so much for joining us. This is the show that helps you find the perfect investment product in the market. Now, before I go on to talk about what we're going to do this week, I've noticed a pattern and a certain trend in the emails that you send us. It seems like a lot of you are very concerned about your real estate investments or that first home that you're looking to buy. Now, because of that, what we're planning to do over the next couple of weeks is put out an entire special on real estate, on buying a home, taking a home loan and finding that perfect property. So you can write to us. There's an email ID at the bottom of your screen and send in any question you might have about either buying a home or taking a home loan or choosing a developer. It'll be our pleasure to help you on this show. Over the next half hour on This Week, we'll first tell you what to do when your insurance policy lapses. We'll help you decide if you should revive it and then take you through the process. In our product review this week, we'll look at the SBI Magnum Tax Gain Fund and we'll find out if you should move the money from your employee provident fund to the national pension system while switching jobs. Today we're talking about life insurance, and the thing about life insurance policies is that it normally involves a 10 or 15-year commitment to pay regular premiums. And it's not unusual that as a customer you might have missed a payment or two and your policy might have lapsed. But that's not too much cause for worry. It's not like you've lost all of your money. You can revive that policy and salvage that investment provided it's worth the trouble. We have in fact put together a quick test that you can use to decide if your lapsed life insurance policy is worth the effort involved in reviving it. If not, then you pull your money out. If yes, then you should also jot down the process of reviving a policy at the end of this report. Take a look.
Back in 2004, Swapnil Thakur bought a unit-linked insurance policy which offered him a life cover of 5 lakh rupees. He committed to pay a premium of 20,000 rupees every year until 2014. Unfortunately, Swapnil was only able to pay the premium for 3 years. After his last payment in 2006, the policy, along with all its benefits, lapsed. Now Swapnil is anxious about what will happen to his money. The only choice left now is to surrender to his insurer. If you are in the same boat as Swapnil and you don't want to let the premiums you have already paid go to waste, your insurer offers you the option to revive or reinstate your policy.
To make sure those policies are reinstated to the original levels of coverage and benefits, the customer has to pay the arrears of the premium, whatever are due. There is some kind of interest payable on that and some kind of paperwork. For example, it could be a medical, it could be a declaration of good health, and once that is done, the policy is reinstated to original form.
But before you go ahead and pay up your arrears, you need to make sure that reviving your current policy is in fact worth its while. First, find out if you are still eligible to revive your policies. All insurers will have a time limit where the option of reviving the policy is available to you. The time limit for a traditional as well as ULIP policy is 2 years after you have paid the last premium. Paid up simply means that you have paid the premium for at least 3 years. Your paid up status also determines if you can recover any of your investments even if your time horizon is over.
If it has acquired a paid up status, then you will still be eligible for reduced benefits. You may still be eligible for getting some reduced death benefit as well as maturity benefit. But if it has not acquired paid up status, then you may have to forfeit all your money.
Next, make a note of all the charges you need to pay to revive your policy. Just paying up your unpaid premiums will not do the trick. The insurance company will slap on additional payments which you will have to adhere to.
Usually the premium is between 9 to 10%. There could be some other charges if at all any, but normally my experience is the outstanding premium plus the interest rate within the vicinity of 9 to 10%.
For a unit linked, you are governed by the discontinuance charges, which is ULIP guidelines. So that's very fairly straight and simple. And at our company as GFC Life, we have revival charges of 250 rupees.
If the policy has lapsed for more than 6 months, your insurance company might want to reassess their risk and ask you to undergo a medical test. If you have developed a medical condition since your last unpaid premium, your insurance company may hike your premium. Now, if the additional charges and a possible hike in premium is putting you off the idea of reinstating your policy, keep in mind that the existing policy comes with its share of hefty surrender charges. You may have to forfeit all your money if you had taken ULIPs before 2010 and were not in a paid up status. Your ULIP policies paid up before 2010 and held for 5 years will attract no surrender charges. According to the new regulation, your policy will be in a paid up status after 5 premiums, and on completion there will be no surrender charges. If your policy is not paid up, you will have to pay the discontinuation charges, which would be around 3,000 rupees for a premium up to 25,000 rupees and 6,000 rupees for a premium above 25,000 rupees. Traditional plans have no fixed rules. If you had a traditional plan for 15 years and paid up the premium for 3 years, then your surrender charge would be 30%. Therefore, the charges will depend on your policy term and the premium you have paid. These charges could go as high as 70%.
The only time, as I said, it might make sense to reinstate your policy is in the case of traditional plans where you are in the last 1/3 of your tenure, or in the case of ULIPs where the policy, old ULIPs, where the policy hasn't acquired a paid up value or hasn't acquired a surrender value.
If you are sure that reviving your policy is your best option, the actual process of revival is quite straightforward.
You need to speak to your insurance company as well as agent, more so insurance company. Tell them that there has been a default on your part, and then they may have some form filling requirement. If they do, if they don't, that's fine.
If you bought your policy after 2010, it will be governed by a new set of guidelines formulated by the regulatory body, which gives you a chance to recover your money even if you can't revive your policy.
In the new policies, where recently the IRDA has changed some rules, even if you lapse policy, you may still get some money after 5 years, because the money goes into a discontinued fund and that will be paid with an interest to the policy holder after 5 years. So contact insurer and find out whether you are still eligible for some benefit and when you are eligible for that benefit.
If you cannot afford to pay the premium any longer, several insurance companies may allow you to continue the policy on a reduced premium and life cover.
Let me invite Dhirendra Kumar, the CEO of Value Research, in this leg of the show. Dhirendra, thank you so much for joining us. Let's get straight to our portfolio.